Peace and love, good people. Peace and love. So we are looking at the daily time frame and at the head and shoulders bottom pattern on the daily time frame. This is a medium term bullish pattern. So let's learn more about the head and shoulders bottom. The head and shoulders bottom is a popular pattern with investors. This pattern marks a reversal of a downtrend in a financial instrument's price. All right, a head and shoulders bottom is considered a bullish signal. It indicates a possible reversal of the current downtrend into a new uptrend. So this sounds like this is something we want to see in a bear market or a recession. We want to see a head and shoulders bottom. All right. Now, volume is absolutely crucial to a head and shoulders bottom. An investor will be looking for increasing volumes at the point of a breakout. All right. So we're looking for increase in volume. This increased volume definitively marks the end of the pattern and the reversal of a downtrend in the price of a stock. A perfect example of the head and shoulders bottom has three sharp low points created by three successive reactions in the price of the financial instrument. It is essential that this pattern forms following a major downtrend in the financial instrument's price. The first point, the left shoulder, occurs as the price of the financial instrument in a falling market hits a new low and then rises in a new minor recovery. The second point, the head, happens when prices fall from the high of the left shoulder to an even lower level and then rise again. The third point, the right shoulder, occurs when prices fall again but don't hit the low of the head. Prices then rise again once they have hit the low of the right shoulder. The lows of the shoulders are definitely higher than that of the head, and in a classic formation are often roughly equal to one another. Roughly. You see that? Roughly. The neckline is a key element of this pattern. The neckline is formed by drawing a line connecting the two high point prices of the formation. The first high point occurs at the end of the left shoulder. You can see this on the diagram down below. And beginning of the downtrend. The second marks the end of the head and the beginning of the downturn to the right shoulder. The neckline usually points down in a head and shoulder bottom, but on rare occasions can slope up. So watch out for that. The pattern is complete when the resistance marked by the neckline is broken. This occurs when the price of the stock, rising from the low point of the right shoulder, moves up through the neckline. Many technical analysts only consider the neckline broken if the stock closes above the neckline. So we gotta exercise patience, all right? The stock can do whatever, the candle can do whatever it wants, but we need to see what happens on a close. The volume sequence should progress beginning with relatively heavy volume as price descends to form the low point of the left shoulder. Once again, volume spikes as the stock hits a new low to form the point of the head. It is possible that volume at the head may be slightly lower than at the left shoulder. When the right shoulder is forming, however, volume should be marked lighter as the price of the stock once again moves lower. It should be markedly lighter as the price of the stock once again moves lower. It is important to watch volume at the point where the neckline is broken. For a true reversal, experts agree that heavy volume is essential. Again, volume. All right, so let's look at criteria that support. This is crucial. Back to the basics, back to the foundational concepts that we leverage on this channel. All right, criteria and support. Support and resistance. Look for a region of support or resistance around the target price. A region of price consolidation or a strong support and resistance line at or around the target price is a strong indicator that the price will move to that point. Again, look at that. They basically said that support and resistance is a strong indicator. Excuse me. The location of the moving averages. Here we go. The head and shoulders bottom should be below the moving average. Compare the location of the pattern to a moving average of appropriate length. For short duration patterns, use a 50-day moving average. For longer duration patterns, use a 200-day moving average. Okay, moving averages are crucial. The moving average trend. The moving average should change direction within the duration of the pattern and should head in the direction indicated by the pattern. For short duration patterns, use a 50-day moving average. For longer patterns, use a 200-day moving average. Okay, so the volume again, volume. Volume will usually be higher on the left shoulder and lower on the right. A strong volume spike on the day of the pattern confirmation is a strong indicator in support of the potential for this pattern. The volume spike should be significantly above the average of the volume for the duration of the pattern. All right, so that's crucial. And there's other patterns to consider, other reversal patterns such as bullish and bearish engulfing lines and islands. They occur at the peaks and valleys and indicate strong resistance at those points. The presence of these patterns inside a head and shoulders is a strong indication in support of this pattern. All right, so criteria that refute. We basically just going in reverse. No volume spike on a confirmation. Poor location of the moving averages. The moving average trend is counterintuitive, which makes the pattern unreliable, and the short inbound trend. All right, so I hope this gives you a foundational insight. Maybe you never heard about the head and shoulders pattern. Maybe you haven't been looking out for it. Now you have an idea. So we want to be mindful of these patterns on the larger time frame, the daily time frame, which can help us create a bias in terms of the direction of the stock for the shorter time frames, the 1 hour, the 15-minute, the 5-minute, the 2-minute. All right, our key time frames. So we're looking at patterns on the daily time frame to create a bias. We want to be like, yeah, this thing is going up. Yeah, this thing is going down, or it's been going up, or it's been going down, and find our entries on the lower time frames. Okay, peace and love. I hope you get rich. Looking forward to connecting with you again in the next video. Leave a comment, please. Like this video. Let's get 100 likes. Let's subscribe if you haven't already, and put in the comment section down below if you've seen a head and shoulder pattern in enough time to leverage it and trade, and has it helped you make some money in this bearish looking market. All right, see you in the next video.